Started a couple of companies, and then became an angel investor, as many of you know, and invested in 150 companies. In the first 100, 6 of them became unicorns.
Wow.
So that's a pretty good hit rate, one every 25 or so overall. I've invested in 150 companies total. And I plan on investing in 30 to 50 a year for the next 5 years, which will put me in the 300 investment range. Hopefully we get another 6 unicorns, so that would be 12 unicorns, which would make me hopefully the greatest angel investor of all time, which is the goal, to see if I could be the best ever.
Okay, that's an amazing goal. However, that's not the odds. If you read your book on the cover, you said, well, if you cannot afford losing money, you shouldn't be an angel investor. So, and also you said that winning in angel investing like winning lottery. So what's the odds like to winning, not 6 unicorns, how about winning 1 unicorn?
Sure. Well, if you're here in Silicon Valley, we know that there are thousands of startups that are created a year, and hundreds of them get funded. And we have a couple of dozen unicorn companies right now. So given that your chances of hitting one are very low, maybe it would take you here in the Valley a couple of 100 investments to hit just one. But if you did hit one in the early phases, it would almost definitely pay more than 200 or 300 to 1. The problem is most people don't have access to the deals. They don't know how to pick deals. And so the reason I wrote the book was to try to explain to people some strategies for lowering the number of misses and increasing the number of hits, and teaching them how to go slow at the beginning. If you're just starting angel investing, it's like if you just learned how to play poker. If you just learned how to play poker today, would you go sit at the biggest table in the casino with the most money and the most experienced players? The answer is no. But people do that. They come to Silicon Valley, they go to a demo day, and they have a $250,000 bankroll to invest in startups, and they decide, I'll put $150,000 of it, half my bankroll, into one company. And typically that one company's been looked at by dozens of other investors, and they've passed. So I think you have to go very slow, take your time, and learn. And it's not guaranteed, and it will take 10 years as an angel investor to see your investments realized. But there are many reasons to become an angel investor outside of making money. If you're an angel investor, you get to hang out with the smartest people in the world, the most driven people in the world, as they try to change the world. This is an amazing position to be in. Even if you were to lose half your money doing it, half of your the amount you allocated, if you're only allocating 10% of your net worth and you lost half of it, you would lose 5% of your net worth. If you were investing in the stock market and other vehicles, you'd probably make that back in under a year on average. So I think most people don't take enough risk. They should take more risk, but they should do it intelligently. So the book tries to outline, hey, there is a lot of risk in angel investing. It's a very risky asset class, and it has a 10-year horizon. But if you do hit, it could change your life forever. It could change your life and everybody in your family's life and their neighbors' lives forever. Like, it can be a big, big win, and there's massive upside potential. And I think the downside, if you do it intelligently and slow, I think the downside is actually capped. You can only lose 5 or 10% of your net worth if you only bet 5 to 10% of your net worth. And if you get even a handful of companies that return a little bit, you should be able to get to break even, I believe, if you invest in this market, Silicon Valley.
Okay, great. However, I hear many angel investors are indeed losing money. I want to know is that, let's say, for people to bet, not the unicorns. Unicorn is not easy to be hunted. So let's say even like a couple $100 million exit for the angel investors. What's the odds look like? And how to improve how many investment have to do in order to...
Yeah, I think in terms of having a decent portfolio, you probably want to have 30, 40, 50 investments, which if you were doing one a month would take 3, 4, 5 years of primary investing if you did one investment a month. So I think if you look at your primary investment period as 2 or 3 years. And then you look at the harvest phase when you mentor them and you collect money as the next 6 or 7 years. So that's how most venture capital firms look at the world. We'll spend 3 or 4 years investing this fund, and then we'll spend 6 years managing that fund and collecting the returns. So you got to take a 10-year horizon and probably hit 30 or 40 to have a decent chance of hitting a big return. The biggest mistake you can make is doing 3 investments, 4 investments with all your money. What you should do is take half your money, do small investments. So let's say you were doing just syndicates, $5,000 each. If you did 30 companies, $5,000 each, that'd be $150K. And then if you invested $150K in the top, say 5 of those, you'd put $30K into each of the highest performing of that first group. That would be a wise way to do it. Because if 25 of the first 30 companies went out of business and only 5 survived, those 5 you would have 25K in, and you'd have lost the other 125K. But then you invest 30K in each of those 5 winners, that 150K plus the original 25K is still in the market. It is still alive. It still has a chance of return. So you would look at that and say, okay, 180 of the $300,000 I invested is still in active companies. So you want to be able to quadruple down, 5x, 10x down on your winners, because there's about 5 or 6 opportunities to invest in a startup before they go for Series A. You want to, if you get one that's a winner in Sequoia or Benchmark or somebody else invest in it, you want to double down, triple down, quadruple down.
Cool. So, being an entrepreneur, I'm sure many of the angel investors are also successful business people or entrepreneurs. So, which is the winning strategy? To start a new company or be an investor?
Well, it's really 2 different jobs. If you're going to be an investor, the pro is you can sleep at night, because if 9 out of 10 of your companies fail and 1 succeeds and it pays more than 10 to 1, you're going to be fine. So you have a pretty good diversification of your assets. When you're the founder of a company, you get a big portion of the money, you get all the glory, but you can't sleep at night. You have to worry about payroll, and you have a majority chance of failure, and you have all of your eggs in one basket. So the chances are, for a founder, any individual startup has probably a 60 or 70 or 80% chance of failure. It's only 1 out of 5, 1 out of 10 that will succeed. So you really have to do 3 or 4 companies in your life to have a success. So for entrepreneurs, it's a much harder life. Angel investing and being a venture capitalist is a very easy life. I've done both.
It's an easy life. So among the successful angel investors, I know a couple of them. Ron Conway.
Yep.
I consider YC as some form of angel investing as well. So, and also there's a couple of pretty big angel network, Sandhill Angels, Bound of Angels. What I hear the challenge of that is many of the angels not doing well, including many of angel network, because the activities from the professional institutional angel investors, like first round, Ron Conway, SVE Angel, and YCs. Now, those people has a team. They made a professional life by doing earlier stage investing. This just started last, 5-7 years, become pretty popular. How does the small angels compare with those professional institutional angels?
So if you're just starting out as a small angel, I think being part of an angel group, there's very little downside. You don't have to participate in every deal. You can learn. But the truth is, the deals that those angel groups see are typically the deals that couldn't clear the market with the top angel investors. In other words, if your startup, you would go to Ron Conway, First Round, myself, Homebrew, Cowboy Ventures, Aileen Lee, Cyan Bannister, you go to all those early stage top tier firms first. If you can't get to them or they pass, then you would probably go to the angel groups. And so I think most of the angel groups get what's left over after the professionals have made their investments. So if you're in an angel group, you might be investing in, you just have to be aware that you might be seeing the companies that couldn't raise money from the professionals, and that should give you pause. Just like some of the websites out there, I won't go into them, but there are some crowdfunding websites, equity crowdfunding websites, that have very questionable deal flow on them. Companies at very high valuations selling common stock, no rights for the investors at very high valuations with unproven revenue. And I think it's kind of the loser brigade at some of those sites. AngelList, Seed Invest, and Republic seem to be higher quality deal flow, but the other ones seem to be lower quality deal flow. So you have to be very careful and learn. And then what happens is, let's say you make 10 investments in a syndicate. I have my own syndicate, Jason's syndicate. It used to be on AngelList, now we do it on our own. If you're in a syndicate, or you're in Gil Pinchina's syndicate on AngelList, or you're on Seed Invest, those platforms or those individuals have de-risked some of the risk because they're only going to invest in higher quality companies, and you get to tag along. The only price you have to pay is 20% carry, typically 15, 20, 25% carry. So if there's a win, 20% of the winnings goes to the syndicate lead or the platform. But that's a small price to pay to learn and draft off of the more professional investors. Also, once you've done those 10 investments, even if it was for $1,000 each and you invested $10,000, you could meet the other angels in each of those companies. And that's what I did when I was starting out. I would just email people, cold email. Hi, we're both investors in Thumbtack. Hi, we're both investors in Wealthfront, Uber, DataStax, Robinhood. And once I made that big list of 300 or 400 investors I co-invested with, I would send them all an email. Have you seen any interesting companies? The next company I'm investing in is CafeX. Let me know if you want an intro. So I would just send that casual email. And then people would tell me about the deals they were seeing. That's called proprietary deal flow. Proprietary in that it's not public and it's unique to you. So if you're just looking at what comes to your angel group, and there's no diss to the angel groups, but they make decisions by committee, they're not responsive, some of them charge the founders to present. So most great founders don't even bother with angel groups. They would just rather get a check from some famous angel and have them on their team rather than having a bunch of no-name angels who are part of a group do it, right? So they would consider it a waste of time. What you want to do is build up your own proprietary deal flow. And then maybe you're an expert on something. So if you're an expert on AI or sales or CRM systems because you were a sales executive or a business development executive, or you worked in biotech or medical devices doing sales, or you were an engineer at Facebook or Google, you could pick a vertical that you're passionate about and you're knowledgeable about, and then pitch founders who are in those verticals. So if you're passionate about machine learning and algorithms, and you worked at Google for 15 years or 10 years or 8 years, and now you're transitioning into angel investing, you really have a valuable skill set for people going into AI. And you can just email them. I worked at Google for 6 years doing algorithms. I found I'm now an angel investor, would love to get coffee with you and hear your vision for your company. Short email like that, I would say 9 out of 10 founders will take the coffee. And if you email those co-investors, I would say maybe half of them will reply and maybe 20 or 30% of them will go get coffee with you. So you have to put the work in to build your own network to have proprietary deal flow if you want to be excellent at it.
Great. You read a chapter about how to pick up $1 billion founder. By the time you did a couple earlier stage investment, by that, think of Uber example. At that time, do you strongly believe it's a $1 billion company?
I thought there was a chance it was a $1 billion company, but I was basing my investment in Uber on Travis, who was an incredible founder, who I knew would be successful at whatever he did. And I knew he was hardworking and passionate. So I try not to figure out if the business is going to work. I try to figure out if the person is going to succeed. So if there's any law, any Jason's law of angel investing, Jason's law of angel investing is, I don't need to know if you're going to succeed. I don't need to know if your business is going to succeed. I need to know if you're going to succeed. And if I can determine you're going to succeed, I'll invest in this business and the next one and the next one until you get lucky or get your timing right and hit a big, huge home run. So if you look at a company like Airbnb, How many people here have stayed in an Airbnb? Raise your hand if you stayed in an Airbnb. Great. How many people have hosted another person in an Airbnb? Hosted them in your Airbnb. So there's 3 Airbnb hosts here, and 9 out of 10 people in the audience have stayed at an Airbnb. When I heard the idea for Airbnb, I immediately thought, oh, you let people sleep on your couch or in your extra bedroom like a serial killer would. And if you're a host, I immediately thought, oh, you're going to let somebody sleep in your apartment while you're sleeping in the other room? Like you're inviting a serial killer to come stay at your house and then murder you in the middle of the night. And I don't think there's been an Airbnb murder, but there have been Airbnb trashing of apartments. There was a meth party famously in somebody's apartment. So I immediately looked at it and said, I didn't have an opportunity to invest in Airbnb, but I would never be able to get past my biases in thinking this is a crazy idea. I would never participate in it. I would never stay in an Airbnb, let alone host somebody. I'm just too risk averse, right? Like I'm just going to assume that I'm going to be murdered. And so, but I was completely wrong, right? My thesis is wrong. Obviously, you've all stayed in an Airbnb and you've never been murdered. And I'm assuming none of you have murdered anybody in your Airbnb. That might be an assumption that I can't make, but I'm going to make the assumption that you haven't murdered your host in your Airbnb. So what I've learned over time is nobody knows exactly what's going to work. And the more confusing an idea is or confusing a product is, and the less people believe in it, in a lot of cases, that's a good indicator that it could succeed. So when you look at something like Uber, there's a long list of reasons of why Uber and Lyft will not work. There's a long list of reasons of why Tesla and electric cars will not work. And 7 or 8 years ago when I got my first Tesla, the little Roadster, everybody said, oh, range. The range is only 150 miles. This will never work. People need faster range, and it's too slow. It only puts 10 miles into the car. So overnight, you can basically refill the battery. So that was the big reason why Tesla would fail. Now I just drove the Model 3.
Is that the reason you didn't invest Tesla?
Well, I wasn't investing back then, so I didn't
see.
even consider it a possibility, even though I could have at $1 a share. What really happened was, now I just got into the Model 3, and it had 300-mile range. And I just got the battery pack on my Roadster replaced, and now it's a 320-mile range. So what was the biggest criticism of Tesla now makes no sense. You can drive to LA without stopping. You can drive to Tahoe without stopping. And by the way, there's 7 different superchargers on the way at every McDonald's, at every In-N-Out Burger, and you can just put extra mileage in. So the reason of why something's not going to work today and how quickly technology moves to figure that out is a very short period of time. And sometimes companies don't make it. Like there was a chance Tesla wasn't going to make it to the 4th version of the car, but they did. And once they get the 4th version, they have incredible escape velocity. So I've learned to not doubt founders and the right founders and try to look for those people who are passionate about the idea, who have massive skill and massive knowledge.
Great. However, look back is easy.
Yeah.
Let's look forward.
Sure.
Can you name maybe 2 to 3 companies
Sure.
you invested the last 7 months this year?
Okay.
7.5 months?
Yeah.
Months, which you strongly believe. We'll take it's recorded. We'll check back
Sure.
2 years later. Which one you believe
Yeah.
can be unicorn?
So I believe CafeX and Blockable will easily become unicorns.
CafeX, Block. Tell me why.
Well, CafeX, I met the founder 2 years ago, and he sent me a video of a robotic arm making coffee. And I couldn't tell if it was real or not, so I wrote back, is this a joke? And he said, no, it's not a joke. We made a coffee machine at our university, and it makes coffee for people, and they only have to wait a minute, takes up less space, and it's 24 hours a day, and you don't have to pay any humans. And I thought, okay, what are Starbucks' biggest costs? Humans and rent. This eliminates 90+% of both of those things. So, and it's open 24 hours a day, which Starbucks are not. And so I was like, come to my incubator. They came to the incubator. We raised a couple of $1 million for it. We syndicated the deal, so a lot of other angels got to be part of that deal. And they have 1 machine at the Metreon. They'll have a couple more machines this year. And I think when they have 3-4 machines in Soma in San Francisco, they will have proven what the payback period is for the machine which will be hopefully under a year, in which case the business will print money and still be able to charge people 25% less than you pay Starbucks to get coffee that is better than Starbucks and as good as Phil's or any other place. And you will have to wait under a minute for your coffee and get it 24 hours a day, as opposed to wait in line for 20 minutes and it's open for 12 hours a day or 14 hours a day. So I think that one has got the potential to be a $50 billion company because they're just getting started.
What's the valuation will you invest?
Well, when they come to the incubator, we typically put $50,000 or $100,000 in for 5% of the company. So that's a very good valuation. That's a $1 or $2 million valuation, but that's because the company's also coming to the incubator. So I'd say some portion of that money we're buying the shares, and then we get probably 3% or so, 4%, depending on the company's maturity level, in kind for running the incubator. And then the valuation went up to 6 or 7, and then up to 10, and then 15. So I think right now, objectively, the company is probably in that Series A range. They'll probably be able to get they've raised a couple of $1 million, but I think they'll get a Series A from a great venture capitalist after they have 3 or 4 machines in the market. And if they do that, and you can get Benchmark or Social Capital or Sequoia or Greylock, one of those great firms, to actually focus on it and help build it, it could become a unicorn. The other one, Blockable, is a bunch of Amazon executives who are building homes that are modular, so you can go on your phone, pick a home, pick a destination, put your credit card in, and have the home be built by robots and shipped to you within X number of weeks or days or months, depending when they get the system up and running, what the demand will be. But they've got a huge pipeline of people who want to build infill housing, which is housing between the suburbs and the cities, which is desperately needed, right? And there's a bunch of parking lots and open lots and spaces where you could modularly put in 20 of these units and have 20 apartments that are studios and another 20 that are 1 bedrooms and another 10 that are 2 bedrooms, and you just modularly put them together like Legos, and they can stack. So it's sort of like the container ships that you may have seen people doing it with containers. The problem with containers is they're heavy, ugly, and they're not very good for air conditioning or heat, and you have to live in a cage like a rat in a metal cage. They're designed to be ugly, and they're designed for a different purpose. But that concept with really beautiful design, and so I think those two will be unicorns.
Great. We'll note that one. I'll check with you 2 years later.
Okay.
Okay. So you also mentioned that for angel investor, in order to be successful, must be a friend with the founder. Here's the challenge. You invest in 150 companies already. You anticipate you can invest another 150 companies next few years. How do you get the time? You are running 3 companies. How do you get time to be friends with the founders?
Well, tonight I'm taking 8 people to dinner. So if you imagine that was a normal dinner with me, that would mean I'd have dinner with 7 founders. If I did that 50 weeks a year, I could have dinner with 350 founders. So there's ways to scale. Also, there's this new thing, email, which is super efficient. I don't know if you guys have tried it yet, but it's really awesome because you can send an email to somebody and then respond on your time, and it works pretty well. Also SMS messaging, groups. So I like to do group events. We'll have our Angel Summit up in Napa every year, and I'll bring 50 angels together and 50 founders. So I get to spend time with the founders and the people who co-invest with us. 100 people come. We have dinners, lunches, hikes. We went clay pigeon shooting, wine tasting. So I like to create events where small groups of people, 5 to 50, can hang out together, spend time together, learn, and network. And those small events you don't hear too much about, but those are the ways I do it. Other people just don't spend time with their founders.
Cool. So how does our founders community, how can we participate in your events?
Yeah, so the great news, Launch Festival, Scale, and those events, we give 90% of the tickets away for free. And then when we do charge for tickets, we only charge for if you're coming to the breakfast, lunch, and dinners and the special events like that, because they don't scale, right? If I had a room like this with 50 people, 100 people, or 500 people, it's the same cost, generally speaking, for 50 or 500. But once you start doing dinner, it doesn't scale. because you have to pay a lot of money, and you only have a certain amount of space in restaurants. So generally, if people want to come, they can just go to the websites, and if they join my email list, we usually tell people, if you're a founder, apply, get a free ticket. Sometimes it fills up and there's not enough room, and you can buy a ticket. The events usually have tickets for $200 or $300. They're not expensive. We try to make it very accessible. So pretty easy. Go to launch.co and sign up for the email, and you'll get the alerts for that. Yeah.
Okay. So since 60-70% of tonight's audience are entrepreneurs, founders, maybe you can tell from an angel investor's perspective, how will the founders approach the angel investors? I know we have too many choices now. Not everyone is easy, but there's incubator, there's a seller, the professional VCs, then there's angel investors. Let's say, particularly how much effort, how do they approach to angel investors?
So venture capitalists don't want to see companies typically until they have $1 million run rate, $2 million run rate, $3 million run rate. The VCs, venture capitalists, have moved downstream, generally speaking. Most of them don't want to do a Series A. So if you're just starting your company, you really have no chance of getting money from them. You might get a meeting just because they think you're interesting and they want to meet you, but I would generally say, unless you've had a successful exit before, you're not going to get venture capital. Now, the angel class, you should know your audience. Some angel investors or early stage investors like Jason Lemkin focus on SaaS and SaaS only. He doesn't care about consumer. And then you might have somebody like Homebrew, where I think because they worked at YouTube, they understand consumer really well, and they're doing the Skim and some other consumer products, so they might be more apt to do consumer. In all cases, I think trying to game the angel investors is not as important as trying to focus on curating your customer base. So know which angel to approach at which time by looking at their existing investments and what they say. I always say, I'm looking for people in my Goldilocks zone. Too hot is they have a Series A already. Too cold is they have an idea. I don't want to meet with anybody who has an idea, because the number of people with ideas right now is the total population of planet Earth. Everybody on planet Earth has 100 ideas a day, and 2 of those ideas are a $1 billion company. So literally, I believe that every person on the planet probably has a $1 billion idea a day. It means nothing. Congratulations. If you think your ideas are special or unique, you're kidding yourself. And business plans don't matter either. What matters is you can, on your own skill, get a group of people together for yourself and build a prototype and get it to market. That's what qualifies you today in 2017. If you're not able to build the prototype yourself or with your friends or people you convince to do it, you're probably just way out of line with the reality of today's market. In today's market, people are building their prototype off of sweat equity, off of bootstrapping. So maybe they have a customer who will pay them in advance, or they build a very rudimentary version of Slack, or if it was Slack, they get their previous company to buy 100 seats for $10 a month, and they have $12,000 a month, $12,000 a year in revenue out of the gate. Or if it was 1,000 people, maybe they get 100,000 in revenue out of the gate. So you have to understand that you're in a competition with other founders. And if the most you can provide to the angel is your ideas or a business plan or a deck, you're probably not going to get funded. But if you can show a product and traction, even modest traction, the chances of getting funded go way up. So if I meet with somebody and they have 5 to 10 customers for a SaaS product, that's fine. I know out of the 10, 4 of them are your friends. I know 3 of them are not paying, but I'm going to guess 3 of them are people that you called on the phone or reached out to you and paid you. So those are the 3 that I'm going to look for, and I'm going to ask, of the 10 customers you have, how many did you know before you started the company? How many are paying? What are they paying? Let me see the contracts. So instead of optimizing to get meetings or optimizing to try to trick angel investors to invest, I think optimize to get those customers, optimize to get the first 1,000 users for your app every day. And the answer I get sometimes from people is, oh, well, I don't have any money to start, and I need to do that. I need your money to get started. And that's just out of sync with the market today. You've disqualified yourself by saying something like that. If you're waiting to build your startup until I give you money or another angel gives you money, you've literally disqualified yourself. Because what you've told them is, this idea is not so important to you that you are going to build it. You have no ability to, with your own charisma, to get 2 or 3 developers or friends to build this on the weekend. So you have no charisma, you have no passion, and you have no skill. Because you're like, well, I can't design it. I'm not a product manager, I'm not a marketer, I'm not a developer. I was like, well, what are you? I'm an idea person. Oh my God, that's the worst thing you could ever be, is the idea person. Like, we just said earlier that everybody's got a bunch of ideas and it means nothing. So I think you have to understand where the market is today. The market today is people are applying for incubators with a finished product. They're applying to incubators with 10K or 25K in revenue a month for SaaS products. They're not applying to incubators to finish their products. So if you think you're going to get funded off of your idea in 2017 or your business plan in 2017 or your deck or that getting a meeting with me, I'm going to magically change my Goldilocks zone, it's not going to happen. I have too many deals that already have 5 or 10K a month in revenue. Why would I do one that has 0 in revenue and it's just an idea, right? We're picking which founders to bet on. Well, would you bet on a founder who's clever and who can make something out of nothing? Or would you bet on a founder who can't do any work until you give them money? You would obviously bet on the former, not the latter. And the trick for you as a founder is you're just trying to get a meeting at the right time. And one of the tricks is to send a monthly update. If you meet somebody and you're not in their kill zone, in their Goldilocks zone, just ask them, may I put you on my monthly update so I can share our progress every month? And if I get a monthly update from somebody 5, 6, 7 times, I read them all. I look at them because it costs me nothing. But
You do.
it takes me 2 or 3 minutes to just scan it, look for a chart, look for customers, and I just look at it and go, okay, oh, they want a startup competition? Bullshit. Oh, they got an article in TechCrunch? Bullshit. Okay. Whatever, they got how many likes or they got followers, like, okay, bullshit. Oh, they got a customer. Oh, and that customer's paying this amount. Okay, not bullshit. Oh, they just hired somebody from Google to come work there as a co-founder. Not bullshit. Oh, they just hit, this cohort that downloaded it when they were on Product Hunt. 60% of them are coming back a month later. 40 of them are coming back 2 months later. Oh, they're tracking their metrics? These people are legitimate. This is a legitimate startup where they know what they're doing. So you're just trying to put yourself as a founder in a bucket of this person is going to be successful in life and they're dogged and they have skill. If you're in the bucket of no skill, no passion, not dogged, you've disqualified yourself. So this is not like, universal health care. Not everybody qualifies for angel investing. It's not your God-given right to be invested in by an angel. You have to earn that, and they have choice. So you just have to know that that's the reality in 2017. If we were sitting here in 2007, there were like 2 new companies a week, 3 new companies a week in town. So every year there'd be 200 or 300 interesting companies, and you could basically, as an investor, meet everybody. Now, you go on Product Hunt or AngelList, and there are how many companies on Product Hunt every day? How many products, not companies, but there's 200 or 300 products every day. Of those, probably 50 of them are actual companies, or 25 of them are actual companies. So every month, there's arguably thousands of companies. And there's just not enough angel capital. So one of the reasons I wrote the book was to try to inspire more people to be angel investors, but also as a handbook for founders. So a lot of founders realize, and I get these emails literally 10 times a day. Hi, I'm a founder. I read your book. This has been an amazing way for me to understand what angels are going through. It's really leveled me up in how to pitch them. And by the way, I would like to pitch you on my startup right now. And it's like, wow, that's super savvy. So if you're a founder, I think the book will be as relevant or more relevant for you than if you're an angel.
I'm sure the audience have some question. I'll ask my last question. It's about the location.
Yeah.
You mentioned that angel investment is a very local business. Local could mean 2 things. A, the angel is local, means the founder is local. Mm-hmm. In my F50s network, we do get lots of international investors. We do have international investors in that as well. So I'm wondering that will international investors get a piece of cake in Silicon Valley? First question. Second question related is that will the international founder, for instance, the founders from Israel, India, or Europe, just move their headquarters here? Will it work?
Sure. I'll take the second question first. I see a lot of founders keeping their company in Israel or in Hong Kong or in Seattle or Austin or New York, but having a headquarters or a satellite office here. Because it's so expensive here, not all companies want to be based here, and actually not all the talent in the world is here. We just happen to have a lot of talent here, and we happen to have a magnitude more capital. So if you're trying to raise money and you're in Austin, Texas, you can meet with every investor in a week. In Los Angeles, you can meet with every investor in 2 weeks. In New York, you could meet with every investor in a month, maybe 2. In Silicon Valley, you could never meet every investor here as a founder. Because when a company like Uber goes public, or Twitter, or Google, or Facebook, or Instagram gets bought, or WhatsApp gets bought, it creates another wave of 100 or 500 investors. And it creates a wave of thousands of millionaires. So we constantly have more people jumping into angel investing and new venture firms starting. So here, it's so much easier for a founder to raise money. And you will never run out of investors. I know many founders who were in LA who just at a certain point were like, well, we met, Rustic Canyon, we met Science. They don't really cut checks. They just incubate companies for 30 or 40% ownership or something crazy. So there's just no investors down there, or very few. When they figured out there's very few investors, they all move their companies up here, or they come up here on a regular basis. Now, as an angel, to your first question, I've only lived in Silicon Valley for 3 years. I lived in LA for the last 10 before that, and I would come up here every week for 2 days and do my angel investing, and then I would go back to the sun. And beautiful life in LA. But after a certain period of time, I was like, if I'm coming up for 2 days, then 3 days, I was starting to spend more time up here than down there, so I moved. And I had hit so many good investments that I wanted to be here. But I think you can fly in as an angel investor here, meet with 20 companies over 3 days, like literally 1-hour meetings back to back, and meet 6 companies a day and meet 15 companies or something in a 2 or 3 day trip. You would select them before you get here over email, and you could go back and forth from China or New York or London. But you, as an angel investor, you have to determine if you're investing for return or impact or a little bit of both or some other reason. Some people like to be angel investors because they just feel a great sense of joy backing young entrepreneurs and seeing them try. Like they just do it for the thrill of it. I get the sense Mark Cuban is one of those people where he likes to win and he doesn't need to make any more money, so why is he writing $250K, $500K checks? It will have no impact on his life. I think he does it because he loves it and he loves entrepreneurship. So if you want to invest in Austin and be the Austin-based angel investor, you could be the #1 angel investor in Austin, run the #1 incubator, and not have a lot of competition, but you might miss out on the returns of Silicon Valley. And if you look at $1 billion, $10 billion, $50 billion, and $100 billion outcomes, they almost all come from here. You have Microsoft and Amazon in Seattle, which are notable exceptions above $100 billion. And you have Snapchat, which is worth $15 billion, but some people would argue it's a $5 billion company. Who knows what the truth is? They've had a rough go of it, and that's the biggest company to come out of Los Angeles ever. And then in New York, you have Etsy, Kickstarter, DoubleClick, a bunch of billion-dollar companies. Stockholm, you have 9, which is weird. So on a per capita basis, Sweden's doing something incredibly well. And of course, you have China, where you have a large number of big companies coming out of there already. So it's possible for innovation to come from anywhere, but it's probable that the big returns will be here. So if you're doing it, if you're angel investing primarily to get a return, I advocate doing it here, because this casino has the best odds, right? It's like
casino.
if you look at it like a casino, I tell people, if you're investing here in the companies I talk about, the Goldilocks zone companies, it's like playing Texas Hold'em poker, and the first card you get is the ace of spades every time. If you could play Texas Hold'em at a casino and you knew that you got the ace of spades every time and the other players didn't know, you would play in that casino. Because the worst hand you could have is like ace 3 or something, or ace 4. Ace 2 is actually probably pretty good. You can make it a straight. But you've got this incredible chances compared to other people. It's like playing the lottery here. If you play the lottery here, you've got to match 4 numbers. If you play it in Austin, you've got to match 10 numbers. If you play it in New York, you've got to match 8. It's just statistics and odds. And if you invest in companies before they have their product released, 99% of companies that get money and try to then build, if you invest in those companies, you're taking on all the risk of them getting the product to market at a time when most people can build a Twitter competitor or Facebook or LinkedIn or Uber competitor or Airbnb competitor. They could build the prototype of that and get it up and running in a city for $250K, $100K, some amount of sweat equity. So if even those companies could be recreated very quickly and cheaply, why would you invest in the people who've proven they can't, right? So I think you have to be a little cutthroat about that. If you want to invest in companies pre-launch or when they have an idea, I don't do that. And I'm one of the top 5 investors of all time on an angel investing, as an angel investor. So if I don't do it and you're starting out as an angel, you should definitely not do it. Unless you think you can, maybe you're Steph Curry and you can hit half-point shots and change the game, and you just know by looking in somebody's eyes, like, I'll give that person $250,000 and they will build a great product and, get there. Great, more power to you, but I haven't seen many people do it successfully. Incubators can do it successfully because they're doing so many companies. So if you did an incubator, it's possible if you did 30, 40, 50 companies a year pre-launch, that a third of them would, or half of them would get to launch, and of those, half of them would get some level of traction, and of those, half of them might make it to a seed round, and of those, a quarter of them might make it to, a venture round. There's better ways to bet. You can bet on companies post-launching their product, and there's probably 5 opportunities to invest in the startup after they've launched their products. How many people here are founders? Great. How many people are founders and have raised an angel round? Raise your hand if you've raised your angel round. That's interesting. So a bunch of founders, only 2 have raised their angel round so far. And so that tells you how hard it is. And of those 2 people who raised their angel round, how many are going to be raising funding in the next 2 years? Again, both of them, right? Like, they're going to raise money every 12 months for 3 years, or every 6 months, or 18 months, some number. And so if you know they're always going to be raising, there's no rush to get in. So I tell angels to take their time. If you don't feel it's right, tell the person, put me on your monthly update, and let's check in 60 or 90 days. And do that 3 times. And maybe 9 months after you meet them, then you pull the trigger. I've seen people, and I've invested in people a year after they first met me. And I said, they said, why didn't you invest? I said, I'd like to see a little more progress. It's not a no, it's a not yet. So I tell people, not yet. And they say, well, what is it going to take? And I said, more. I say, more what? Revenue, users, engagement, team, any of that. Other investors. But I'm not ready yet, but I would like to stay in touch. So I think that's play the long game with investors. If you don't get them right now, curate them over time is my best advice to founders.
Great, I heard lots of numbers. It's amazing you remember all those different numbers. I'm sure our entrepreneurs want to hear you come back a lot more, but today, that's all my question. Let's open a couple questions from the audience.
So you're talking about proprietary deal flow.
Sure.
You mentioned Cafe X is the one who sent to that list of 300 fellow investors. I think you've got an incredible amount of gravity at this point as an investor because of your success. As an early stage investor that is just getting their start in researching companies and generating this proprietary deal flow, where would you look for angel seed stage companies that are? I mean, you can go to CB Insights.
You're talking about you, not him, right?
Yeah, for a new one, yeah. So I guess where to source deals.
Yeah.
So the 2 best ways to source deals are to talk to the existing founders you've invested in and your co-investors, because they're getting emailed constantly, they're choosing to meet with people, and they're making bets. let's say you've invested in 5 companies. If you tell those founders, if you meet anybody interesting and you would consider investing in them if you had a fund, send them along. No need to ask permission, just intro me.
So first-person research, you think, is off the table?
I think first-person research,
Like you digging into a specific vertical and knowing it inside and out.
I think it's a fine idea to, if you were thinking that you liked robotics, to look for every robotics company on Crunchbase, Mattermark, CB Insights, and every other place, and just meet 10 of them. And if you meet with 10 people, you can always ask them, have you seen any other interesting companies in the robotics space? You could host a robotics lunch or dinner. You could say, I know 3 founders who are in robotics. I'll invite them to dinner. There's 4 of us. Get a table of 8. And then you ask the other 3 people, hey, do you know anybody else in robotics? Or you use their reputation and say, I'm having Blockable, CafeX, and Ready.io, GetReady.io, 3 robotics companies I've invested in. I'm having dinner with them, and we're going to just do a little roundtable discussion. I was wondering if you want to join us. It's just 3 really interesting robotics companies that I've invested in. If you ask 20 other robotics CEOs to meet 3 other robotics people, how many do you think are going to say yes? I think 2 out of 3 will say yes. So you'll have 15 yeses. And then it's just a matter of people are in town. So I think small meetups where you're the center of gravity. So now I'm a big center of gravity, right? Like I'm the sun now. But when I started, I was a little moon, right? So I have things orbiting me, like the podcasts, the events. And so just things naturally gravitate towards me. Great investors say, oh, if Jason's involved, he's got a big Twitter following, he'll probably tweet about the company like he tweets about Wealthfront or tweets about Uber or any company. Calm.com, you see me not shut up about these companies. When they start doing well, I talk about them more. And if they have problems, I even talk about them a lot and how to solve the problems. So, but until you're that, and you don't have that kind of gravity yet, you can create little gravitational moments, right? So don't be afraid to do small things. I was the outsiders. Nobody wanted me around. When I used to go to Tim O'Reilly's E-Tech in San Diego when he ran that, I couldn't afford the $400 ticket, $500 ticket. So what I would do is I would stay on somebody's couch in LA, drive to San Diego for the day in a rent-a-car, sit on the couch all day long, out in the lobby, meet people coming in and out, rent a Mexican, get a table for 6 or 8 people at a Mexican joint, buy a bunch of appetizers, host a dinner, find 2 or 3 friends there, and then once in a while, somebody would have an extra ticket and loan it to me, and I get in. And then I'd say, hopefully I'd run into a friend or somebody, and they'd say, oh, what are you doing? I said, well, I'm going to probably drive back to LA. And they're like, oh, I got a hotel room. You want to crash on my couch? I'm like, yeah, I have my bag with me. And I would literally crash on people's couches. That was how I did it in the early days, was just to be everywhere, even if people didn't want me there. And trust me, some people didn't want me there. And then once in a while, people got so sick of me, they would just literally, Esther Dyson or Tim O'Reilly would just be like, here's a ticket. Don't tell anybody I gave you one. Because they're just like, it's so embarrassing to have Jason in the lobby sitting there with no ticket, lobby crashing. But I had no sense of shame about it. I was like, I'm going to be successful someday. So I'm going to hustle now. This is 15 years ago.
Wow.
10, 15 years ago. I was like a hustler, just trying to get in. I didn't have any money. It's before I sold weblogs in 2004, 2005. So it was like, over 10 years ago, and I would just hustle my way everywhere. And that's what you have to do, is show that hustle. And don't be ashamed to be a hustler. Be a hustler in the early days. And out hustle these VCs, dipshits who are, on vacation for 4 months a year. They're literally on vacation 4 months a year. Nobody will take a meeting. Guess what? If you take a meeting with all these entrepreneurs who are trying to raise money and you become friends with them, all of a sudden you've got your network. Trust me, like the big name VCs are not meeting with the entrepreneurs in this room yet. None of them have raised money. Only 2 of the 25 entrepreneurs here have raised money yet. So they'll wait. But if you take the meeting with them and you provide value by listening, by asking good questions, and by being helpful in other ways, like, hey, maybe I can introduce you to somebody, or I had an idea about your product, or here's a competitor, or I read this article. Just try to be of service to everybody you meet. And try to take out less than you give back. Just give a lot. And I think you see that with me too, right? Like I'm here to speak here, and I wrote the book, and I do the podcast twice a week. I taped an episode with Kevin Kelly today. I'm constantly trying to put content in the world or meet people and help them. Even at this point in my career, I still want to be helpful to people and try to inspire them or give them tools to do better. So you can do the same thing. And you don't have to be big and famous and have a book by Harper Collins. You know, like, you don't need to have that. You can have a blog. That's how I started. I had a blog. It was my first book. I earned this book by hitting 3 unicorns. But you don't have the ability to write a book now, but you can write a blog post. You may not have the ability to host a podcast, but you could be on a podcast, right? So you give yourself time and hustle.